You gotta admit, a 50-year mortgage sounds insane until you see the math. Because once you calculate how much interest you hand over the bank over 5 decades, at that point it's not a loan, it's actually a wealth transfer machine. And here's the trap. Banks love these mortgages. They lock you in for life, maximize your interest, and keep control of your financial future. But here's the twist. You can escape that 50-year sentence in less than 10 years. Just by flipping the system they designed against you. Let's get into it. One of the most important things you can do when you are going to war, any war, is to know your enemy. And today we're going to go ahead and know the enemy called the loan. Now, it doesn't matter if it's a mortgage, if it's a car loan, if it's a student loan, any loan, you've got to know how this loan is set up. In this example, the mortgage, 80% of your minimum monthly payment. Okay, that's the payment you have to have each and every month to stay in that house. 80% is actually going towards interest. Okay, here's an example. $400,000 at 6.25%. The minimum monthly payment on that is $2,462. Now, of course, that's divided between principal and interest. Okay, in this example, at the end of 1 year, guess how much of this payment went towards principal? About $4,687 worth. All right. While towards the interest, $24,867 went towards who? The bank. That's at the end of 12 months. Now that's on the 30-year mortgage. If we hop over here to the 50-year mortgage, we're going to see something a little bit different. Now, remember, the number we focus on is what? That's right. As cash flow bankers, we focus on the minimum monthly payment, $2,179 each and every month. But this is how it is getting divided at the end of that year. $1,192 going towards the principal. $24,966 goes towards the bank. Do you see now why I say you have to know your enemy? Because if you just look back, okay, what is the problem with this? Well, the problem with these numbers, I would say especially this one, is you're paying $2,179 a month. Why in the world at the end of 12 months is $1,192 being applied to principal? At this rate, you'll get done with this loan at 50 years, at the 50-year mark. At this rate, you'll get done with this loan at the 30-year mark. Do you see why it's important that you know your enemy? Okay, so now that you know your enemy, what are we going to do about it? I'm glad you asked. Let's get into that. Now, for those of you who already have the Money Max account, you, of course, don't have to worry about any of this. The software actually lets you know what to do with your money so that you're out of this in very less time, in less than 10 years, some even less than 7 years. All depends on the cash flow. Notice I didn't say income. So if you have any questions about the Money Max or the Velocity Banking Wizard that helps you out of this, it's actually in the description link below. So here's what we're going to do. And I want to present this challenge to you. You've noticed that I've actually erased the 30-year mortgage. Do you know why? I erased it because that's too much coming out monthly, okay? Even if it's just over $200 monthly. I want as much cash flow as I can get, okay? And so that's why I chose the 50-year mortgage. Now, you may be asking, yes, but don't you know what your interest is going to be? Yes. Well, guess what? The interest rate doesn't matter. And I'm going to take it a little further than that and say that the years don't matter. Because it doesn't matter if it's a 30-year mortgage, 40-year mortgage, 50-year mortgage, or even a 100-year mortgage. Do you know why? Because I'm not going to pay the way the slave master wants me to pay. I'm going to pay the way a Velocity banker would pay. All right. And I'm going to share with you why that's the case. Now, look, that saved me going to the 50-year loan. That saved me over $200, right? Over $200 each and every month. I can deploy that $200 way better than the bank can. Okay. I can grow the wealth for me instead of the bank. Okay, so this is what we're going to do. We're going to make sure that we make the switch. Okay, remember what that's called? It's called the interest transfer. Okay, and a lot of bankers are taking into the account that there are responsible people, responsible financial allocators who actually have, right, this income, okay, low in some eyes, but they have high cash flow. And they're looking at that and they're saying, well, wait a minute, maybe we need to redo what we've been taught, because these people are actually very, very wise when it comes to allocating their finances, because they notice that velocity banking is catching on. People are learning about it and they're changing their standards. That's what we want. Okay. So here we have an income of $5,000, the expenses $3,000, the cash flow of $2,000. And we have a line of credit of $12,000 at the 10%. Now, of course, that 10%, that is the cost of borrowing money. That's what an interest rate is. So what we want to do is we want to use our line of credit not as a consumer. We want to use our line of credit as an investor, okay? We want to use that as leverage. But how can we do that? How can we get rid of this 50-year mortgage very quickly with this line of credit? This is what we can do. Remember what our focus is when it comes to loans, and this is any loan. Our focus is time and balance, okay? This is what I want you to do to your interest rate. You can actually do this right now on your statements, okay? Whether it's a credit card statement, loan statement, do this to your interest rate right now. Go ahead and put a line through it, because when you're paying the velocity banking way, you're not going to be paying the slave master's way. No way, no way. Okay, so the $400,000 at the 6.25%, you're not going to be paying that. This is what we're going to do. We're going to aim this $12,000 that we have, that's not even ours. It's somebody else's. They're giving it to us, especially if it's an unsecured line of credit. They're giving that $12,000 to us. And we're going to use it wisely. We want to deploy the $12,000 towards this number here, okay? This is called the principal. Now, why do we want to do that? Because the smaller the principal, the smaller the interest. That means the smaller this number is, the principal, the smaller this number will be, okay? The less goes towards the bank and more will be going towards the principal. Does that make sense? And so let's go ahead and share with you how that's done. Now, it's important to remember that we not only eliminated the $12,000 in principal over there, but what we've done is we've essentially transferred the amortized interest towards the better interest called simple interest. That's what we want. We don't want complicated interest. That's what I call amortized interest, okay? It's complicated. I mean, even the formula for amortized interest is complicated. We don't want that. We want simple interest, okay? That way, we can use our line of credit, okay? Now, here's how you're gonna pay everything off, all right? We're gonna use our line of credit as our new checking account, meaning that income, it's going to go into the line of credit and do what to the balance? It's going to decrease it. So let's say the minimum monthly payment on this line of credit was $600 a month. Where does that $600 a month go? To you. You still have control of it, okay? And so let's take how long we're going to be in this line of credit. We have $2,000 as debt. We have the balance of the line of credit as $12,000, $2,000 as debt. Let's go ahead and see how many months we're going to be in this line of credit. We'll go ahead and cancel out these zeros. And 12 divided by 2 is, that's right, 6. 6 months we're going to be in the $12,000. Now, at the end of that 6 months, what's going to happen? You're going to replenish your line of credit again, all right? And what are you going to do with it at the end of that 6 months? Are you going to deploy it again? Absolutely. You're going to deploy it again towards that $400,000. Well, now it's not $400,000. It's much less. It's 400,000 minus the 12,000. You want to go ahead and just do that math here? Let's go ahead and see if I can do it in my head. What is that? 388. Am I right there? Yep, it's 388,000. I went ahead and checked. You know, you got to make sure. All right. And so what you're going to do is at the end of that 6 months, okay, you're going to do it again and again and again. Remember, we don't want to pay the way they want us to pay. Do you know why? Because if we do, we'll be in the mortgage for 30 years. If we do, we'll be in the mortgage for 50 years. And heaven forbid, we'll be in the mortgage for 100 years if that's what they want us to do. But see, for Velocity Bankers, we don't care what year they put on it. We're not going to last that 50 years. No, we're going to get out of it much sooner. Now, I promised that it would be less than the 10 years, right? Now, some of you, it could be less than 8 years and a 50-year mortgage. And boy, are those bragging rights. Right, man, you can do a presentation on that. All right, because now we're on a whole nother level. So now that we know that we're going to be paying the line of credit, right, with our check coming in, and then we're going to, those expenses coming out, right, they're going from the line of credit. That $2,000 is staying within that line of credit. That's what's paying it down. So now we want to see if this is something that is actually can be paid down in less than 10 years. Let's see what the numbers say. So guys, I tried to do it, and of course you can do it with extra payments because there are ebbs and flows. When you get your bonuses, you can actually put more towards it to break it down that it's even further, right, below that 10-year mark. However, gotta be honest with you, gotta be transparent. If you're just doing it like what I'm doing right now with the math, it's not going to be possible. But with the Money Max account, it'll definitely show you how you can be out of it in less than 10 years, as well as our Velocity Banking Wizard. Okay, so go ahead and just tap on the link below. I think it's somewhere here as well. All right, 10 years and 1 month, you're out of a 50-year mortgage. Man, look at that. And this is the part where I want you to look at, though. You know what you're saving in interest by doing it the Velocity Banking way? Over $722,620. That's right. So if you were continuing in that 50-year mortgage, it would be well over $1.1 million in total payments. And I don't know if you can do better with the $1 million than the bank can. I think you can. I think you can. So let's go ahead and make sure we're out of that as soon as possible. But let's circle this number right here because I want you to come with me down a road here. All right. What is the most precious commodity out of these two? Is it the time or is it the money? Listen, you can always create more money. But you can't create another second of time. And we've actually shared with you how to time collapse your loans with money. But time is what we're talking about here. And this $2,179 at the end of that 10-year and 1 month mark, as that's continuing to come into your bank account, if you still have another 20, 30, 40 years to retirement, I want you to know that you can actually retire with this amount in 3 to 5 years. It doesn't matter. It doesn't matter where you are. Maybe you're 18, right? Maybe you are 45. Maybe you are 56, 65. 3 to 5 years. Just get my people. It's actually in the description link below of the passive income. All right. We want to share with you how to do that. Now, let me go ahead and I will get out of the way so that you can copy this down. All right. And this is your 10-year path. Folks, it's nothing that you can't do. You can do it, all right? Notice how this person did it with a $5,000 income, all right? You can do it because this number, right? we don't want to focus on. We don't even want to focus on the expenses. What we want to focus on is the cash flow. Just like blood is the life of the flesh, it's the life of the body, so cash flow is the life of your bank account. It's the life of your business. That's what matters. That's why we chose the 50-year mortgage over the 30-year. The 30-year was going to cost us $200 in cash flow. And in this society, at least in this time, cash flow is king. We want to make sure that we are the king maker. Does that make sense? Let's get out of the way. Screenshot this, put it on a t-shirt, put it on your whiteboard. Show your husband, show your wife, show your spouse, right? Hey, let's do this. I think we can do this. Let's go ahead and schedule us some time. Let's get the Velocity Banking Wizard. And if you have any questions, this is the movie. This is the show you want to watch right here. God bless you, and we'll see you in another video.